Hi there, everyone. It's PJ Patterson here to give you a market update for the 23rd of September. It's Monday, the 23rd of September. We had a really big week last week in the markets, and I'm going to discuss a number of things. But the top three things that I'm going to hit on today are the Fed and what they did last week at their Federal Reserve U.S. Fed meeting, the Commodity Research Index Bureau Index, which is an index of 30 plus commodities. And it was very interesting to note some chart action there, and I'll just talk about that briefly. And then I want to touch on some earnings and what's happening with earnings, because I think that we are setting up for a very, very interesting October. And so let's get into the Fed and what they did last week. So the Fed had a policy meeting last week, an interest rate meeting. They cut interest rates by 25 basis points, which was probably, well, the market expected there to be some sort of cut. I think the market was hoping for a 50 basis point cut, but the Fed only delivered 25 basis points, and they sort of signaled as well that they're going to be data dependent, and frankly, the U.S. economy is doing okay, and the stock market is sort of hovering near all-time highs, at least in the S&P 500 terms. And things aren't really that bad in the U.S. Employment, wage growth is happening. Unemployment rate is not, too bad. I think it's reasonably low, historically low. It depends on the measure you use, of course, but the broad-based measure of unemployment is low and declining. So the Fed's in a bit of a tight spot. The market wants QE. They want ever decreasing interest rates, because that's just the world that we are currently living in. And so if the Fed doesn't deliver that, it is going to continue to drive the U.S. dollar or give support to the U.S. dollar. And this is a key issue for people like Donald Trump, because if the U.S. dollar strengthens or stays strong relative to other currencies, it means that U.S. manufacturers and goods that are exported from the U.S., which of course is a big part of their economy, retain or are expensive relative to other places in the world, and as such, it can hurt corporate profits. And I'll talk about that in a minute when we get to the third thing, which was earnings. But it's quite interesting to see that the market has not sold off the U.S. dollar, and it continued to be quite strong. In fact, it rallied a little bit after that interest rate decision. And if the market really did think that the Fed was dovish enough, in other words, they were going to cut interest rates, continue to cut interest rates, the U.S. dollar would begin selling off. So the U.S. dollar is a very important metric, and something that I'll be continuing to watch to see, when it really ultimately rolls over. It has, I think, begun that descent, but it's really going to be, a lot of that decline is going to be interest rate dependent, and depending upon what the Fed does. Now, on your screen, you can see a listing of U.S. Treasury maturities. So from 3-month to 30-year U.S. Treasury maturities. And what I want to point out is there's a relationship that everyone watches between the U.S. 2-year and the U.S. 10-year Treasury, and they call it the 210 spread. Basically, what's the difference between the two interest rates? And right now, you can see that the interest rate on the 2-year is 1.68, and the interest rate on the 10-year is 1.72. So literally about a 4 basis point gap between money that you can borrow for 2 years and money that you can borrow for 10 years. And one of the things that a lot of people watch is if that spread inverts. So in other words, if the 2-year money, the cost of 2-year money is more than the cost of 10-year money. And this is something that precedes recessions. Now, we don't have to have that happen to have a recession in the U.S. You don't technically have to have 2 quarters of negative GDP growth to sort of be in a profit recession and an earnings recession. You can still have economic conditions that are like or very recessionary without actually calling a recession technically. Hopefully that makes sense, what I just said. In other words, you can still have a lot of really poor economic conditions, which we have plenty of those, and not actually technically go into a recession. But that 210 spread is something that is a metric that a lot of people watch, and when it does invert, it often, as I said, signals recession is a possibility. The fact that this is lining up now, and the spread is closing. In fact, we may see it invert this week or next week. The fact that this is happening and going into October, which is traditionally a period of time where we get horrendous market crashes. So all I'm really saying there is that October is one of those months that traders like to get through and be done with, because many of the crashes that have occurred throughout the last 20 or so, 25 years have happened in October. And there's some reasons for that, and it's often because of the cycle and because of earnings reports and because of just the timing of a lot of data that comes out in October, and it just lines up that that's the month where there are crashes. So I wanted to touch on a couple of charts real quick. So there we go. I talked about the 2-10 spread. As you can see, it's sorry, that's the 2-year Treasury yield. This was back last week, I think on Thursday. You can see that it spiked up into the Fed meeting, but then has subsequently sold off. And this is a function of the Fed probably not being dovish enough. But the next topic I wanted to touch on was the Commodity Research Bureau Index. And one of the interesting things about the CRB index is it's a very broad basket of commodities worldwide. All your softs, so all your grains and your cattle and hogs and stuff like that. Your base metals, zinc, copper, steel, all that sort of stuff. And it generally is a indication of the health of the global economy. Now, look at this chart, right? What does that tell you about the health of the global economy right now? Not too good. And the way you can tell that is from left to right, that chart is in decline. We have lower highs and lower lows. And what that tells you is that that the global economy is not doing so great. Because if it was doing great and we had a lot of great GDP growth and there was a lot of consumer demand for goods, you would see that chart from left to right going up into the right-hand corner, and it's just not doing that. We did see a bit of a run-up in the CRB index, which is this red circle here. I think in anticipation of the interest rate cut, and it rolled over. So you can barely see it, but it just went up and then it went zoop right back down. So again, if you just follow this trend line down, it's gone up to sort of resistance area, and it has hit a ceiling and it's rolled over. And this often happens when news or an event is expected. There will be buying, or there will be what's the word I'm looking for? Enthusiasm or excitement around, we're going to get out of the woods here. We're going to have enough dovishness from the Fed, and then they don't provide the dovishness or the cowbell, the cash, the quantitative easing, and then the thing sells off. And so what you would see this index doing if the world thought that the Fed was dovish enough is you would see a breakout. And of course, that's something I'll be looking for, is you would see a breakout. You would have seen this trend line spike and continue to spike up into and break that trend line down. So because it hasn't done that, again, what this is signaling is that Fed's not dovish enough, world's still in trouble, and until we see this breaking out, we're not out of the woods. Now, another confirming factor of all of this is the Asian indexes. And I just wanted to show you a couple of charts. I'm going to pull up a couple more of some individual companies in a moment. But if you look at the Hang Seng Index, this is the Hong Kong index. As you can see, China and Hong Kong are signaling that, first of all, they don't believe in a trade deal. And I've been talking about this for a while now. No trade deal. Because this index, if there was a trade deal and it was really about trade and not the health of the global economy in totality, you'd see this index, just like the CRB index, you'd see this index popping up and then breaking this downward trend line, and then probably going on to make newer highs or higher highs than what we have seen over the last year and a bit. And again, left to right, trending down. So, and we continue to see little spikes and sell-offs. So not a good sign. Not a good sign for the global economy. Just a couple of the Asian markets. This is the Shanghai market. So this is the mainland Chinese market, and same deal. It's exactly the same chart from left to right. It's going down. I mean, you've seen some some pretty deep sell-offs, and then you've seen it rally, usually off the dovishness of the Fed. China has done some stimulation as well, and we've just kind of seen it roll over, and it's now just, again, still trending left to right in a downward sloping fashion. What's this? This is the Nikkei. Nikkei, fairly similar story. The data out of Japan continues to be horrendous. Some data points out of China last week were horrendous, and again, just not signaling global growth and global health. This is the Kospi. I've talked about Dr. Kospi before. What's that chart look like? I mean, all of these charts are non-confirming that we're going back into global prosperity. And I'll touch on what we're doing about that in just a moment. And then we already touched on the Hang Seng. Now, I just want to show you a couple of company charts. Hopefully this has come up on your screen. Last week we had U.S. Steel and FedEx report Q3 earnings. And both of these companies are global behemoths and are very big bellwethers of the global economy. And what happened is U.S. Steel, and you can see it on this chart, see this gap here, U.S. Steel reported really bad earnings. I don't know the exact number that they reported, but I think their earnings were down something like 10 or 15%. They signaled that it was going to continue to be a poor environment, and that the stock absolutely got hosed on the day. Gapped down, opened down, and is probably just going to bump along this lower bound here, and who knows, it could very well hit new lows. I don't invest in U.S. Steel directly, but again, this chart tells you everything you need to know about the world economy. Back in mid to late 2018, when we had all that stimulus coming out of the Fed and so forth, we had U.S. Steel up around the $30 level, and then it just has been a slow grind down. If you were a U.S. Steel shareholder, you would absolutely be cringing right now. You've lost half of your stock value. That's one of them. And then FedEx, I just wanted to touch on FedEx as well. It's a similar chart, so we'll just sorry, I'm trying to get the FedEx chart going. Here we go. Similar sort of tails. So I'll just zoom in on the activity from the last week. FedEx again came out with a horrendous number. Now they move stuff around the world, right? Overnight. That's their express and overnight delivery of goods. And here you go, right? They reported really bad earnings. The stock gaps down massively. Huge caning of FedEx. Again, a global behemoth, a global bellwether in terms of the health of the economy. And if they're not moving a lot of stuff, then their earnings aren't going to be so good. And guess what? Their stock price is going to get caned. Now, the reason I bring these two up, and again, this chart, as I've been commenting about charts, left to right, look at that chart, very similar story in all of these charts. So just to get back to this page where you can see me, I'll go back to the bonds. What we actually see here at the moment is, and we'll see into Q3, is more and more companies are going to be reporting poor earnings. And I think we're going to see that in a number of sectors, but certainly it's not going to be a good reporting season. If you have two bellwethers like U.S. Steel and FedEx coming out and getting absolutely hosed, then now's not the time to be positioned in a lot of U.S. equities exposure. The place to be positioned, which is where we are positioned, is continuing to hold bonds. So U.S. Treasuries across the curve, all time frames, gold stocks, gold itself, utilities, and REITs. All of these things do well or better in an environment where the U.S. Fed is, and globally for that matter, interest rates are being cut. And it's only going to really be a matter of time before we see gold continue to accelerate its rally, and for the U.S. Fed, off the back of probably what will happen in October, is we'll see some sort of, I don't say we're going to see a stock market crash, but we'll have to see some sort of sell-off before the U.S. Fed does anything really to really cut interest rates to the point where the market goes, yay, we've got enough of a cut now that will bid up the price of stocks, etc. So to wrap all this up, I continue to be out of stocks, and largely speaking, out of stocks, not exposed to technology, high growth, high beta, any of that stuff. We're hovering in the safety of cash, of treasuries, of to some degree corporate, really high quality corporate debt, and then finally the metals. And that's right now where we need to be because we are in global quad four, and that is bad. That's interest rates declining, inflation declining, GDP declining. All of those things mean that all the interest rate sensitive stuff, bonds, bond proxies, all of those things do better or well in that environment. So it's called full cycle investing. We're at the part of the cycle right now where we're about to roll over into probably a cyclical downturn. And in doing so, rates are going to be cut and continue to be cut. Quantitative easing will probably get restarted at some point, and we'll be off to the races in a lot of these asset classes. So all that being said, if you have any questions or comments, please leave those in the chat or shoot through questions in our Facebook page, the boardroom. And as always, if you have any individual questions about portfolios and so forth, please do give me a call. Hope you have a great week. And for those of you who watch these regularly, I am traveling to Thailand this week for a conference, and I will be gone until I think I get back on the 7th of October. I will be checking emails and working and doing stuff while I'm away, but there might be a delay in getting back to you. And of course, I will leave a market update or do maybe a couple of market updates from lovely Bangkok. And once I see what's happening on the ground there, and having a little bit of a holiday, but sort of a working holiday. Anyway, have a great week, and I'll talk to you all very, very soon.